More market warnings as stocks continue to move higher. This is Tom Aspray with the Viper Report video for the week ending October 17th. Well, you can see this snapshot from a Google search. Gives you kind of what people are looking at as we head into the next week. Remember, we started last week with the surprise 100% tariff talk on China. Of course, by the weekend was over, those tones have been modified. Still, stocks got hammered on October 10th, and the market fought back all week. So during the week, Jamie Dimon talked about cockroaches. You know, when it comes to regional bank earnings, a lot of talk about an AI bubble. I've been through a few bubbles in my life, gold, internet. Trust me, nobody was calling about a bubble in those times. So, and Jerome Powell raised recessionary fears, and then absolutely a market bubble. In addition to the AI boom, we still have what I've been writing about for a couple of months about the low cash levels, and the fund manager survey dropped down to 3.8%. That's never a good sign. It's been 3 or 4 months since it's been at those levels. In my experience, that's quite rare. We'll probably write some more about it later, but that's the background thing, is that at some point, all the money is going to be plowed in, and there'll be nobody left to buy. Don't think we're quite here yet. As you can see below, we had a pretty good week. Dow up 1.6, the market leading Qs up 2.5, New York Composite up 1.5, S&P up 1.7. Transports came roaring back. They're sort of economically sensitive, so that's generally an encouraging sign. However, on a year-to-date basis, they're still the only one that's lower. Dow keeps plugging along. We've been in the XLU for a number of times, up 17.3% year-to-date. And, of course, gold, we've been trading that in and out. And then we got the breakout of that trading range during the summer. So took some profits, but still holding on to some longs. And small caps had a good week. Still don't like the action there. So let's look at some charts. Let's start with the New York Composite, the weekly chart. You can see here that we had closed off the best levels on Friday, but still higher, up 1.5%. You can see it has a tail up here, so these prior 2-week highs. But overall, the technicals, the weekly stocks only, of course, that usually tops out first because it only has stocks, whereas the all has bonds too. But it flipped back above its moving average. Of course, it could still flap back the other way, but the trend there is still positive. We really need to get above this resistance line B. The all AD line, it's held above its moving average. Broke out to another new high in June, and that was bullish. The stock market, it still looks pretty good. S&P 500, nice rally from this bottom point B, and once again, we had this huge rally up, came back down. Where did it stop? At a prior high. So of course, this level in here is major support still, the high from early in the year, and don't think we're going to get a correction right down to that level yet. 20-week EMA 63.90, and we closed at 664. Still a number of Wall Street firms are projecting a yearly close down in those levels. I doubt they'll be right. S&P 80 line has been leading on the way. It turned up from its moving average. It's got support here, support in here, and then major down in here. Last week, the bullish percent, according to the AAI, dropped about 9 points, I think, and the bearish rose 9 points. So now the differential here is 12.4%. That means there are 12% more bears in the survey than there were bulls. You can remember down in here, it was quite a bit different. There were 40%, you know, more bears than bulls at that point. And, just last week it was plus 10, so, I was expecting us to see another new high if it hadn't been for the tariff comments. But still, I think that this is starting to be a little more negative because some of the other, as I mentioned, sentiment numbers are also suggesting too much bullishness. Let's look at the daily charts. That's the big drop on the 10th of October. Holding above the pivot, that's a pretty encouraging sign. So, right around 570. Move above there early in this coming week. We should be able to hit the R1 478 outside chance. Of course, we're not getting much economic data, would be in the 690. Theoretically, we're going to get jobs data on Friday, a couple weeks late, but I'll believe it when I see it. So, major buy signal back here. 80 lines all turned positive April 30th. And, and that brings an important point is that, if you're worried about some of those headlines and some of the, people who are selling market crash, we will get a crash at some point. I don't see it right in here. I always tell people if somebody's looking for a crash now, ask them what they were looking for last spring or, in the fall of 2023, fall of 2022, because there are important turning points, you'll find that they're at the real market lows, there are very few bulls. So the daily AD line, has slightly higher highs, flip back above its moving average. Stocks only, weaker, so we need to get above this downtrend and this peak, it's still negative, and you can see all these kind of broke out back at the lows. All AD line is the most concerning. Need to see it get back above this peak to suggest that this just little sideways pattern has been completed and it's going to move higher. If it does, then I think that R2 is a possibility. Weekly QQQ still looks great. Held last week above the prior week's lows. That's a good sign. That's also a good place to, if you're a short-term trader, to have your stop. This AD line has been leading. That's the NASDAQ 100 all the way. Turned up within a few, and I mean a few issues below the July high. So that looks good. Relative performance, it was giving a signal back in here that in April that, okay, the Qs are ready to lead, not leading, and now it's made a new high this last week. So also a good sign. So of course your entry level depends on how worried you should be about a correction. We've been saying for a month or so now that if you're 70 or 80% invested, start taking some profits on strength, and we still feel that way. Comfortable would probably be 50 to 60%, but you can see some of our positions, go way back. I mean, XLC from 88 on April 7th, so that's why it's up 30%. We've taken some profits out. I think we have half the position. Utilities, April 21st, 24%. QQQs, 28.9. Also going back to the 30th. So, managing the risk on those positions, is considerably easier. You don't want to give up too much, but you want to play against the longer term trend. Some of these other positions, we added to the technology in September, so it's only up 8%. Healthcare, we added just a couple weeks ago, and we added for investors this last week. EFA, same sort of thing, 5%. So, we want to protect those, those gains, but we'll give them a little more room at this point. We've been watching the new highs, new lows. You can see there's a definite decline in the number of new highs on the NYSE, but so far we have not seen a real pickup in the stocks making new lows. That's typically the trigger that warns you that, okay, a correction is underway. Currently this last peak I think was a little over 100. So 150, I think is what level we're looking at. If you look onto the, New York or the Nasdaq Composite, a little more glaring. You can see a little slight more intake here. This peak right in here is right around 250, and you can see we had that one off, at the start of August, sharp drop down, a pickup in new highs or a pickup in new lows, a drop in new highs. Now we're showing a downward trend here, so doesn't necessarily mean a top till we see a new uptrend in the number of stocks making new lows. The main negative for the market, of course, is the VIX and the VXN, an increase in volatility. So we've been watching this. We moved above this resistance here early in the month, and then we surged, we broke out. So we were watching the breakout last week. This pullback during the week was pretty mild, so that kept the uptrend intact. We got the sharp spike on Thursday and pulled back. Okay, so going into next week, if we continue get a pop back above 24 and new highs, that will keep that uptrend intact, which is generally a negative for stocks, as it indicates an increase in put buying and general bearish activity. So same with the VXN. Alternatively, if we drop back below last week's lows and the moving average, which is right now at about 19.5 for the VIX, and for the VXN about 23, that would indicate that the rally in the VIX and the VXN is over, and that clears the way for stocks to move higher. Let's focus in on the sector report for the weekend. Those will be going out this Sunday afternoon. You can see 3 DTS, in DD, EAXP, United Partial Service, Coke, McDonald's, and also Starbucks. So, moving into the staples, more generally a more, defensive group. We go back in here, we get to the real meat of the subject here. Let's increase this a little bit more, and you can see, okay, energy. I've been out of this for most of the month, or for most of the year. It should have stayed out. We got stopped out here, but it's looking pretty sickly, and I'll probably send out a updated crude oil chart to clients on Monday. It still looks like there's no bottom yet. So I don't know how they want to drill at these levels of crude oil prices. I don't think new drilling is very feasible. But anyway, MPC, there's a couple of bright spots, not much. Material, it's at 25. Materials 25. Okay, we usually use the 50 level, so industrials are looking a little bit better. So this may be an industrial rally here. You can see RS is still needs a sharp move in the industrials to create a bottom here. Consumer discretionary, still is in a downtrend. So, as I said, we got a few bright spots there. Home Depot too, and Lowe's. 41, so it's slightly below the level. Consumer staples has picked up and moved back above its moving average. So PG, CL, Mondelez, Coke is all positive. Pepsi is leading the way for those of you who try to decide which one of those two to drink. Costco has a 3 DTS, so the rest of it's red, so that might be a market to watch. Healthcare looks great, 83.3. Financials, not so much. Though bank earnings have been pretty good. There's a mixed match of red and green, and you can see the RS still in a downtrend. Technologies ain't giving up yet, so higher highs above the slows above the fast. That's good. XLC, technically we need to hold the lows from a week ago Friday. Sort of a mixed bag here. T-Mobile and Netflix is a 3 DTS in a sea of red. And, Electronic Arts, Meta also has a 4 hours. So, it could move back above its moving average. Technically, it's at some pretty good support. Utilities, been trying to add to that position, no luck. And real estate, not it's crossed above its moving average, so I will give it a look. Things like AVB and WELL. I think WELL triggered a weekly doji buy signal this week, so that might be something to look at. Well, that's all I have today. Please send me your comments and questions to tom@viperreport.com. And in next week's, we'll try to go into the sector reports in a little more detail.